This hearing will come to order. I want to, first of all, welcome our witnesses and thank them for taking the time to appear before us here today, as well as taking the time for your thoughtful testimony. The title of this hearing, The Greek Economic Crisis and Lesson Learned, I think pretty well describes what I want to talk about. A couple of years ago when we saw the riots in the streets of Greece, I think that was pretty revealing in terms of economic models, governmental models that weren't working too well. And one of the first things I did is I asked my staff to do a little research in terms of, describe the level of debt in America versus Greece. And so we produced a chart which we've updated as of the first quarter. I wanted to keep it all relative. And I was rather shocked at the result. I was expecting the debt per capita of Greece to be a whole lot worse than the debt per capita here in the U.S., but I found the exact opposite. So as of the first quarter, the end of the first quarter of 2015, every American share of our federal debt is now $56,000, over $56,000. If you were a citizen of Greece, your share of Greece's federal debt is about $31,000. And I think one of the questions I have for our eminent witnesses is, how can that be, and what does that really portend for America's future as well? So again, I'm looking forward to this hearing. We need to be concerned about how the events in Greece may, what kind of contagion that might produce for the rest of the Eurozone. And of course, if it's having an effect on Europe's economy, it'll have an effect on the world economy. And so it's really kind of the basic questions we need to ask in this hearing. And with that, I'll turn it over to Senator Sheen. Let me just clarify. So when you take a look at this, you're cautioning us, be careful of this because it understates the problem. I mean, that's basically what you're saying. Even though we're almost double Greece's debt per capita, this is understanding the problem because you're looking at the long-term fiscal projections.
It's understanding in that sense, absolutely. There's also currently my debt to GDP numbers that I recited are different than this. That's because they're relative to GDP, not relative to a person. And GDP per capita, of course, is much higher in the U.S. than in Greece.
So let me ask you, how are we getting away with this? When we've got almost double the debt per capita. I mean, why aren't we seeing riots in the streets?
Well, partly, as I say, it's because our GDP per capita is quite a bit higher. So I think in terms of measuring our ability to service, pay back the debt, measuring relative to GDP is probably
is the more
reasonable to do. I think in addition, we have had, if you look at the details of the charts, there's kind of a relatively flat period that's projected for the next few years under the current assumptions. I think that leads to people feel a little bit better about it. Maybe we'll address that problem later. Maybe if it's not you, it's your successors. People are thinking, I don't know. But I think that's part of the problem, why you're not seeing the harm. I would say, though, you do hear a lot of complaining about the economy. You do see problems in certain areas of our country. You do see income per capita stagnating, certainly in certain places. I don't think it's unrelated to the uncertainty about how this debt is going to be resolved. Again, that explosion in my chart is as current law implies, so there has to be a change in the law. What is it going to be? People don't know. Are we going to get the spending under control? Is there going to be a tax increase? Is there going to be a problem with respect to the debt limit? We don't know, and I think that's an element of policy uncertainty. It has to be a drag on the economy right now.
I mean, one of the things we did, and we held a hearing in our Homeland Security Committee with CBO Director Hall, and we've converted their long-term fiscal scenarios, the alternate fiscal scenario, converted that to dollars, and that shows over the next 30 years, which I think is really our problem, the demographic bubble, the baby boom generation, all the promises made, can't pay for them, showed a deficit projected over about $103 trillion over the next 30 years. I mean, talk about unsustainable. Talk to me a little bit about what is being measured in those indicators. Either one of you. The indicators that Dr. Taylor was talking about. I mean, I understand Greece is very high on the Heritage Foundation, but talk about what that actually measures.
The various indices, they measure the rule of law, how independent the judiciary is. They measure how long it takes to start up a business. They measure the degree of regulation and its interference with the economy. They do this in various ways. Sometimes it's judgmental. They may measure openness to trade. That's a common one. It's less judgmental, but even there, how do you measure openness to trade? The reason why I mention several is because they all tend to say the same thing. Because I think to be sure, you have to be very careful on using indices like that. You mentioned my being at the Treasury. At that time, we tried to use indices like this to help decide what our foreign aid should look like to the very poor countries. And there's, I think, a quite strong correlation between these indices and the growth of the economies. Doesn't mean it's causation, but I believe a lot of it is.
I mean, would you say in general, if you had to kind of typify a term, it measures economic freedom, the ability of a free market system to operate effectively without being hampered by governmental interference?
Yeah, I like the word economic freedom, and in fact, it's used in some of the indices. The World Bank uses doing business. It's the same kind of concept. How free are people to start a business? How difficult is it? How difficult it is to operate in the marketplace? But I think the concept of economic freedom is the way I talked about it to my students and try to explain it, because it is a freedom there, which to me, I might say a few minutes, to me, economic freedom requires a strong rule of law. It requires a predictable government policy. It requires orientation to a market system. It requires a focus on incentives and a limited role for government, in the sense of government's role is based on what government should do, not what the private sector can do. It's basically a cost-benefit approach to government policy.
Well, you could argue government should provide that stability of a legal framework for businesses to have some certainty in terms of making investment and understanding what's going to happen to them. Dr. Kahn, can you talk a little bit about, based on those types of measurements, can you compare and contrast, what went wrong in Greece and the differences between Greece and America right now?
I think there are very dramatic differences in the fundamental freedoms, which I would call freedoms, what I call operating conditions, and that speaks to corruption and rule of law. It also just simply speaks to government involvement that is pervasive in the economy. And it also helps to explain your chart in the sense of saying, why is it that some countries have such a lesser capacity to carry debt? Because a country that has a rigid economy, that has extensive government-induced distortions in it, is not flexible to adapt to shocks and to produce a capacity to repay. And I think what we've seen in many countries that have had deep crises, Argentina, one that John worked on a number of years ago, Greece now, that the actual levels of debt measured this way aren't that high when you enter the crisis. That what really is an economy that's not able to adjust, not able to operate anywhere near full employment, where people can't recognize their potential, and so it's not able to generate the resources for the government, or at least the government can capture, in a way that allows it to credibly service its debt. And I think we're very much seeing this at play in Greece. We can compare it very much to the US. We can also compare it, by the way, to other countries in the periphery. I think what we've seen in Spain and Portugal, and particularly in Ireland, are countries that have, since the crisis hit, and by some measures were in equally bad shape, have done a much better job of becoming more competitive, developing new industries, opening those up for private sector involvement in ways that have made them much more attractive to markets now and much more resilient. So I do think it speaks to that issue.
We all hear the anecdotes of Greek citizens being able to retire at a pretty early age, and the general level of the welfare state. Can you make some kind of comparison to America or those other countries that have snapped back from their financial crises?
Among the industrial world, I think Greece does stand out for an extraordinarily large pension deficit. It was 16% of GDP last year in terms of the deficit of the pension system. That required, I think, over 10% direct transfer from the government. These are large numbers, and after 4 years of adjustment. I think, to be fair, it's not so much the levels of the pensions are extraordinarily high, but it is, as you touched on, it's early retirement and exemptions and special deals that have been cut over time as part of the political process. in a way that has political and economic implications. One is it creates this huge and unfinanceable deficit, but it also creates a political problem, because if I'm a Latvian, middle-class worker, and I'm working very hard and working to 65 or now 67, and I'm being asked to finance the pension of someone who may be able to retire in their mid-40s, it seems inequitable and has certainly undermined the politics. So certainly getting at the early retirement system is going to be core for any sustainable solution in Greece.
Thank you. Senator Sheen. Let's talk about the Grexit. The transfer of this debt from the private to the public, even back then there was a haircut for the private sector did suffer pain, correct? Something like about a 50% write-down?
And a little bit more in present value terms, but yes, it was substantial, about 70% by some measures.
So why, I just want to understand, why did Europe do it? What would have been so terrible about letting Greece exit? And what would be so terrible about letting Greece exit now, together with potential contagion, political contagion, from a standpoint of, well, all we really need to do, if you're Spain or Portugal or another country in a similar situation, well, we'll just demand concessions and more debt, more loans from Europe. Can you discuss? I know it's kind of a broad range, but both of you kind of handle that, Dr. Taylor.
So if by exit you mean exit the euro,
yeah.
Yeah. Well, I think that'd be very difficult. It's the euro, debate about whether they should have gone in or not, but getting out is a big deal. You, as a new currency, how that's going to be implemented. Right now, a lot of the debt, the remaining private sector debt, if you call it, is held by the Greek banks, and so it's a big deal to get out. Maybe that's where it's
Can you
gonna go.
describe though what happens, why it's such a big deal?
Well, they'll have to introduce a new currency. You'll have to decide what the exchange rate should be from the euro to the new currency. A lot of debates, and that's hard to do, is in the reverse direction. Germany did that with East Germany. I have some experience with this in putting a new currency into Iraq, actually. As I was at the Treasury, it was one of our jobs to replace the old Saddam dinar with a new dinar. It's a big deal. So there's a lot of things that can go wrong. I would say if it could be avoided, it's probably best to avoid it. And I think to me, that's not the only problem, if I would say too. To me, the problems, I mentioned that, the problems really more are these economic policies that Greece has. I mean, they could be doing very well if they had better policies. That's where I would put my focus.
Dr. Kahn.
Yeah, I suppose I would come at it a little bit differently in the following sense. Yes, there are a set of policies that, if they were as strong as John would like, would put Greece on a course back to growth within the Eurozone. But they are very strong, and I have, as I've suggested, some doubts whether the political economy of Greece can sustain those. If they cannot, for whatever reason, be put in place, then the only way you're going to deal with 25% unemployment, 50% youth unemployment, this is devastating socially within Greece, and should not be a long-term solution, would be to exit, because then you have your own monetary policy, you have your own fiscal policy, and you have a currency that will adjust probably quite a bit to the point that new export industries expand. We've seen this in places like
tourists would start flocking to Greece.
Tourists would come back in, and
really good deal.
It would take a big move, and it would take a degree of political stability, but they would come back in, and new industries would spring up. Intermediate good productions or transshipping things, some agriculture probably. There would be new industries, as well as compression of the imports that go on now. So I actually think that the case for Grexit is actually perhaps stronger from a geopolitical perspective than not. Now, it's almost always painful to do it and incredibly disruptive. I mean, the East Germany, West Germany in some ways was an artificial experiment because it was negotiated and planned. Most of the time this happens out of failure and out of the chaos failure. So you see IOUs often get issued by a government as they're trying to, at the precipice and deciding what to do. A breakdown of payment systems. So when that exit decision occurs, you can have a bank holiday. You can do an initial redenomination, but finding the right prices and deciding whether, what stays in euros and what goes to drachmas is really only a first step of a comprehensive restructuring and workout process. Now, you asked the question at the start, why is it so hard? And I think this is part of the reason. It is very scary, even if in the long run it's good. Part of it clearly is political. Europe has moved quite well ahead in terms of political integration, but the economic integration has lagged. And in particular, the ability to do fiscal transfers of the sort we take for granted that allow that if there's a shock in Texas, while California is booming, that money through the federal system can move, and that is a huge buffer to economic activity. They don't have that. They've been resistant to doing it. The Germans in particular have been resistant to what they would see as enabling moral hazard, of encouraging bad behavior, and the lack of trust between these countries is contributing to that feeling. So I do think that in some sense, this unwillingness to acknowledge either that a country can leave, or that we have to deal with the debt and these kind of issues in this context, in a sense is constraining smart thinking on this issue and limiting them to sort of what the rules allow. And there's been value to having those rules, but I think now we're in a place where they may be counterproductive.
But again, I think you'd acknowledge the probability of this working out, like, okay, this is the last bailout, and they're going to get out the policies right, is quite small, correct? So the next step will be another bailout further in the future, and they will never address the root cause of the problem, which is these awful economic indicators, lack of economic freedom, and as a result, high unemployment, awful business creation, that type of thing. So game it out.
Yeah, I think if the change in the currency obviously would have some of the effects you mentioned. It wouldn't last forever, obviously. I gave you statistics of 30 years of low growth in Greece. It would be a temporary thing, welcome. It may take pressure off the other actions. When in Argentina's crisis in 2001, they devalued, effectively they had effectively a peg and got off it, and it was a little bit of a boom, but it was quite destructive in terms of contracts that were supposed to be owed in one currency versus another, and I think it probably made the situation worse for a while.
Senator Sheen, the moral hazard aspects, I guess you're saying could go either way. I think, as you rightly stated, I think the concern is it's going to go the one way where people say, well, that worked pretty good for them. No sense moving toward economic freedom or cutting back on pensions. We'll just demand a bailout. I think that's more likely. Dr. Taylor, what's your assessment of that?
Of the moral hazard for the debt, further debt reduction?
Yeah, and how that'll affect other governments, other
I think
basically electors.
There's a kind of a political contagion that is certainly you have to worry about and is there. I mean, a lot of people didn't expect the left-wing government to become into Greece, and it's there, and I think it's stabilized to some extent with the other countries, but it's still a risk. I think that the difference here, though, with the usual kind of moral hazard with respect to debt, is that debt's held by the public sector. We usually think that if it's debt, a bailout, then that's going to take away the incentives people have to be careful about who you're lending to, or take away the incentives for a government to watch its budget. It's now another government that's holding it, and so it changes the dynamic completely. It's worrisome to me politically because it creates an enormous amount of intergovernmental tension with different, and personalities can become a big part of it, as we've seen in this case. So it's not so much a moral hazard now, maybe it's just a plain old government hazard that's been caused.
So let's kind of go back to lessons learned, first by kind of going back to the history of Greece. They entered the Eurozone January 1st, 2001. Now, I think there are reports that they weren't exactly forthright in exactly what their financial situation was, but they weren't anywhere near in this deep trouble, correct, in 2001? So I just kind of want the first bailout was in 2010, so it took 10 years. But again, this is only 15 years in the making here. Do you have anybody willing to just kind of go through the history from 2001 and kind of quick walk us through exactly what happened? Again, the whole purpose of that is then to kind of relate to what we're looking at. I mentioned a 30-year window, kind of the definition of our problem, that baby boom demographic bubble. Unfortunately, I got white hair. 15 years, 30 years goes by pretty fast. So who's best to speak to just kind of walk us through the history of the Greek crisis?
I can start, and I'm sure John will correct me on in a couple places. So as you point out, with the start of the euro in 2001, Greek entry was initially fudged. There was flexibility had to already be applied, but to basically say they met the criteria, but it was subsequently learned that they had misrepresented their fiscal data in order to get in.
But their debt wasn't at 300.
Their debt was at quite more moderate levels, and so it was seen as sustainable. Now, the interesting point to emphasize here is that from 2001 to about 2007, there's a great deal of market enthusiasm, right, about the Eurozone, this sort of belief everyone who's in is never going to have any trouble. They're all going to change their policies and become Germany, right? There was going to be this great pull to the higher, kind of a higher level associated with being in. And markets provided, and I have some charts in my presentation, markets provided a great deal of finance at very low rates. There was also, I think, globally, there was a certain reach for yield, if you will, that I think exacerbated it. And so in some sense, Greece could sustain weak policies, weaker than the rest of the Eurozone, and there was little pressure, even though there were these rules, little to pressure them because they had effective market access. Of course, that all changes in the run-up to the global financial crisis. And so then you had this period of time where they basically were trying to delay an inevitable need for a program, and that comes, that the crisis really hits then in 2009, but people had seen it coming really, I think, for some time before that.
So they're in such deep trouble that the deep recession 2009, that was the, basically catalyst for the ongoing crisis then.
Well, I think they had, in the interim, some other problems. I mentioned the interest rates set by this time by the European Central Bank, which may have not been too low for Germany, but most indices are they were too low, at least for Greece, actually Greece, Ireland, and Portugal, and you look at the data. And so that's the too low interest rate, the too low for too long business is a problem. It does cause search for yield. It does create excess borrowing. And eventually, and it was quite a housing boom in Greece. And so all that comes to an end with a thud. So I think during this period, you saw some imbalances, which in terms of your questions about lessons for the US, I think that is a lesson. That was not the greatest monetary policy, at least for Greece at the time, and it's part of the overall policy picture. It was one of the reasons why they had this debt problem today.
Talk a little bit more about what I'd consider just the possibility or almost certainty of the misallocation of capital when you have unrealistically low interest rates. How you do chase yield, how you end up putting money into higher risk assets, create the types of bubbles that we saw burst in the housing crisis. Can you just speak a little bit more to that, because we're still there, correct?
Yeah, there's definitely a risk. You never know where these imbalances will show up. A lot of people didn't predict it was going to be such a problem with respect to housing. And now we look in retrospect and we see it not only in the U.S. but in some other countries. But what happens is if you're a manager of an investment portfolio and you're getting these very low yields, you're going to look for something else. Or if you're an elderly person trying to survive on fixed income, these very low interest rates are going to make you or lead you to take some risks with a higher interest rate. So it's very common. And I think in housing, it's particularly an issue. We have these adjustable rate mortgages, and so the very low interest rates that were set at that time made it very easy for people to borrow. So that's the kind of thing that happens. It's also, in a sense, the market is not allocating capital as much because the central bank is actually keeping the interest rate at a floor. And those cause additional distortions, some of which we don't know about. Some people blame the liquidity problems on that. I don't think it's so obvious. But a lot of these distortions take place because of this very unusual type of policy that's taken place.
Well, the mandatory spending programs, the pensions in Europe, we call them entitlements here, I guess. Mr. Kahn, or Dr. Kahn, you said that was 16% of Greece's GDP. I know in the CBO's ultimate fiscal scenario, the average over 30 years is going to be about 14% of Social Security and our health care entitlements. So we're not there yet. I think currently we're around 8%. Don't quote me on that, but I think that's off the top of my head. So those burdens are going to be Greece-like in not too many years. So again, I just want to walk that thing forward. With Greece, have they always been at 16% since 2001? Did that increase dramatically over that time period, or?
I think it has increased a little bit recently. There were actually some cuts at an earlier moment. But I think, and it's a dynamic that is somewhat similar to the one we've struggled with, although I think on steroids, which is that the fiscal consolidation of the last 5 years. And we should emphasize, there has been an extraordinary fiscal consolidation in Greece. They haven't done all the other structural things we think are so critical for growth, but they have been willing to cut the deficit from, I think the primary deficit was 10% of GDP when the crisis hit, and it was in primary surplus last year, so probably 13, 14% of measures over that period. But what that means is discretionary spending and investment in particular has been cut, to the bone. And there's no discretion for what we think are some high priority investment projects because essentially it's all being that you can't touch for the most part, the entitlements. So in some sense, the desire of the IMF in particular to reform the entitlements is not just about putting overall fiscal policy on the right track, but also creating space for high priority needs.
I always relate kind of national debt loads to a family debt, where if you're in debt over your head, how are you going to grow your personal economy? I mean, any income above what's needed for just the basics is going to service the debt. Is that a reasonable analogy? Dr. Taylor?
No, I think it's reasonable. You have to service the debt, you have to have a certain amount of income. In the U.S., to service our debt, it's got to be tax generated, or the debt's going to just grow and grow and grow. It comes ultimately from taxes. So I think that's the problem with unsustainability. If you look at the CBO's numbers, they have rising primary deficits, as excluding interest payments. And if that occurs, this debt is going to explode. I think that to me, the numbers that are most striking are the entitlement spending numbers as a share of GDP. They just take off. That can't be sustainable. That's really the problem. Discretionary spending, if anything, is flat in their projections as a share of GDP. Maybe even certainly defense is coming down.
They decline, yeah.
Yeah. So the problem is clearly entitlements. And I think there's a reasonable chance to get your handle about it. To me, keep the growth of entitlements roughly equal to GDP. For certain things like Social Security, that's not as hard as it looks. For health, it's harder. But I think if there could be a bipartisan agreement, we've got to keep the growth of entitlements roughly in line with GDP. And then we'll debate about how to do it. Should it be premium support? Should it be other kind of methods? And I think we could tackle the problem. But it is a very serious problem, this entitlement growth, whatever the word you want to use in the U.S.
Senator Sheen. Thank you for attending. Appreciate it. I just have a couple more questions. And it really does relate to that high unemployment rate. But I want to look slightly different statistic. Percentage of population in the workforce, labor participation rate, both of these measurements right now in America, I don't have them right off the top of my head, but they're at some pretty low levels compared to even 10 years ago or 15 years ago. Dr. Taylor, can you explain that?
There's been a lot of research and actually debate amongst economists, as usual, on this. I feel that a good fraction of the decline in the labor force participation rate is due to the weak recovery itself. It's basically jobs are not growing much more rapidly than the population. In fact, the employment to population ratio has hardly budged since the bottom of the recession. It's just now increased slightly. So yes, we're creating jobs, but hardly enough to employ the growing population. So I point to that. If you look at it's certainly more than demographic because the labor force participation rate of young people is down. I think it's an important issue to take up if you want to raise economic growth. You want to raise economic growth, part of that is going to come by employing more of the labor force to get the labor force participation rate up close to where it was before this precipitous drop. And I think that, to me, that should be a focus of policy. To me, you want to have stronger growth, you need to have more jobs, you need to have more productivity. So each worker producing more, those two things. And both have to be addressed. I think and you're asking more about the jobs part, the drop in labor force participation, employment to population ratio. And I think that's, in a way, that's an opportunity. We could get more jobs with a better performing economy. But the other part is productivity.
Well, I mean, isn't an economy a combination of labor and capital? financial capital. I mean, that's so if you don't have as many people employed, you're going to have a smaller economy.
Right.
Talk a little bit about your evaluation of a reduction of median household income, and what's the explanation behind that? I mean, we're literally 5-6 years into a recovery, and median household income's actually declined.
Well, I think it's the same story, and the numbers are harder to measure. But if you're going to have a lower growth economy, say 2.2%, and you're going to have that's going to measure the growth of your income in real terms too, and so that's going to mean growth of income is less. The population is growing, and the labor force is growing too, and the number of jobs is growing, just not growing fast enough. So in some sense, that's the productivity side of it, the income per worker, or income even per person, per capita. And productivity, and maybe this is the best way to answer your question, productivity in the last 4 or 5 years is remarkably low for an expansion. It's like 0.5, 0.6% per year. And so I think that's really the reason for these income numbers that we're concerned about, and it's not clear when they started down or what, but I wouldn't want to debate too much the beginning, the timing, the political part of it, because it's there and we need to address it.
I'm not an economist, I'm a business guy, so I've done a lot of strategic planning. So I've done things like SWOT analysis, strengths, weaknesses, opportunities, and threats. A very simple SWOT analysis. I just kind of want your comment on this. I think America's primary strengths, number one, we're the world's largest market, which means we're the world's biggest customer. And coming from a manufacturing background, I'll tell you, manufacturers want to be close to customers. So from my standpoint, that is an enormous competitive advantage on the global scene. So we're the world's biggest market. We do have, because of innovation, fracking, hydraulic fracturing, horizontal drilling, we've got an energy boom, so we have relatively cheap, abundant energy. So if you're going to manufacture things, you need power. Cheap power is better than expensive power. So, from my standpoint, that's an advantage, and it directs your policy as well as let's keep the energy prices low. On the weakness side of the ledger, our regulatory environment is onerous. There are numerous studies paying that about $2 trillion per year. I know they're disputed, but it gives you some sort of sense. And I always add there's only 9 economies in the world that are larger than $2 trillion. Our tax system is uncompetitive. We're going to be holding a hearing tomorrow in the Permanent Subcommittee on Investigations on exactly, laying out how uncompetitive our corporate tax rate is versus the rest of the world. You have to benchmark these things. Our legal environment does not provide the certainty. All the rules, all the precedents, as a business person, you're very uncertain. So to me, that's kind of in a nutshell, strengths and weaknesses, which pretty well should direct government policy in terms of, well, let's not drive up the cost of power. Let's try and reduce the regulatory burden. Let's make our tax system more competitive, and let's bring some certainty to our legal and regulatory framework. Do you have other strengths, other weaknesses? Can you just basically comment that? I'll start with you, Dr. Kahn.
Just, I agree. Probably list a few more like trade and openness, but the question is getting it done, right? How do we move this agenda forward? And I think that's what I worry about at this point, because there's no question that's kind of the thing that needs to be done.
But we have to understand it. So one of the reasons I throw it out there is you have to simplify what it is we need to, so people understand. Otherwise, you get drawn down in the very detailed policy debates. Mr. Kahn, do you have so trade? You have to keep open markets.
Well, I very much believe that's critical. We need to be able to be the rule setter for a large, open global marketplace that is attractive to other countries to come and participate in. And I think that is a core element of our prosperity and entrepreneurship. Obviously, we talked about these doing business indicators, and I still think in terms of many of these characteristics, the U.S. is still an extraordinarily dynamic and vital economy. I spend most of my time looking at countries that are in crisis, so it may be a low bar, but I think there's still a lot of great strengths to the U.S. economy.
Yeah, and again, we'd like those indicators improving for America. I'll just give both of you a chance. If you have any kind of closing comment, if there's something on your mind or something you want to get off your chest, I'm happy to do that before I close out the hearing. Dr. Taylor, anything?
So tell me more specifically, Mr.
Well, I'm just saying if you have any closing comments before I close out the hearing. Something we didn't address.
I'm sorry. Just more generally, it seems to me the underlying set of ideas here that there are lessons to learn from other countries, and Greece is very important. And we can look you can look at our history, what's worked and what hasn't worked. You could look at different countries. It's a way to convey the important issues to people, to voters, to people in America. So I would say keep it up.
Dr. Kahn.
Yeah, I would just, to go back to my opening remarks, just to emphasize, there are a kind of series of almost subtle decisions that are going to be made by the international community in the coming weeks. It will deal with debt for Greece, but as we've been talking about, with precedent for others. It will deal with the financing and, most importantly, who pays, who picks up that bill. And the IMF is in many ways caught in the middle of it. I think for the most part we should be supporting them, but I think the important emphasis for you, given the committee's jurisdiction and our general interest in this strong, vibrant global economy, is the U.S. should be involved in those decisions, because ultimately, cumulatively, they could have a pretty material impact on how the global economy operates.
Well, thank you. Again, I want to thank both of you for coming here, giving your time and thoughtful testimony and questions or answers to our questions. This hearing is adjourned.